Let's get in Gautam Duggad, though, Head of Research Institutional Equities of Motilal Oswal Financial Services, who joins us on the show. Hi, Gautam. Good morning. Good to see you in. It's a rainy day, which may not be so bad because the monsoons have been pretty okay. Earnings are expected to pick up. And now you have a couple of these bazooka shots coming out. The GST rationalization as well as the S&P upgrade came out of nowhere. Tell us, do you think the Indian markets, after a year or so of underperformance, do you think we're bracing for better times? And in terms of earnings growth, what are you projecting now?
Hi, Nigel. Good morning. Thanks for having me. Yes, monsoon is picking up, which is a very good news. And as you rightly mentioned, after a long time, we've seen over a long weekend, 2-3 very big positive news items coming out, and which has at least lifted the sentiments. For last 12 months, our markets have gone absolutely nowhere, and for right reasons, because the earnings also went nowhere in FY25. As we discussed a month back when we were publishing our preview, that FY26 will be a far better year on earnings than FY25. And first quarter has already turned out to be slightly better than what we forecasted. So we've got about 10-11% growth for our coverage universe, 8% growth for Nifty, which is slightly better than expectation. And as we've been discussing for last 2-3 months, midcaps continue to outperform large caps on earnings. So this quarter, again, if you look at our coverage of 311 stocks, the large cap, which is about 92 stocks that we covered, have posted 10% growth. But midcaps have posted close to 25% growth. Now, even if you exclude one OMC, which has created a very disproportionate influence on the final aggregate number, even then, the earnings growth is about 18% for midcaps and 10% for large cap. Whereas small caps are still struggling because of the issues in some of the financials pertaining to NBFCs and microfinance. So small caps on a reported basis for 132 companies that we track, their earnings have declined 11%. If you exclude financials, then the small cap universe of about 104 stocks have also posted 14% earnings growth. So clearly, we are looking for a slightly better year on corporate earnings. As it is for the last 6 months, government has taken several actions along with RBI, both on fiscal and monetary side. Government had cut income tax rate, RBI has cut interest rate, CRR, a lot of liquidity infusion has happened. Now this GST rationalization, the monsoon is good, and the festive season is around the corner. So hopefully in the second half, FY26, as we enter there, the cumulative impact of all these actions that have been taken so far will start making their presence felt.
Absolutely. Gautam, good morning. This is Vinny joining in the conversation as well. So obviously, given all these positive triggers that have come in, do you think that consumption is something that will be leading the story, especially in FY26 and the rest of the year now?
Absolutely. I mean, the focus of government has clearly shifted from capex to consumption. This was very much evident in the budget. And government has put up a lot of efforts on capex in the last 6 years. 6 years back, the total capex budget of Government of India used to be 1.9 lakh crore. FY25, they spent about 10.2 lakh crore. So that's almost a jump of 5x. Now, you can't keep growing at 20-30% on capex allocation by government on that kind of pace. So very prudently and wisely, they shifted the leverage lever away from capex towards consumption, which is why the potential 1 lakh crore of benefit through income tax reduction augurs well for consumption. However, what has also happened is consumption has been weak, especially on the low ticket side, especially on the staples, for last 10 years. It's not just last 1-2 years phenomena. As I keep repeating, there's not a single consumer staple company in India which has given 10% top line compounding for last 10 years. We just published a review note on consumption today morning. Again, we've given a lot of details on that. Even if you see that note today, there is not a single company which has given 10% top line compounding for 10 years. So consumption needed a support, especially low ticket, right? And that you've got now from multiple announcements already. However, from our point of view, we've been more bullish on consumer discretionaries for last 4 years. And that call continues from a next 1 to 3 year point of view. Short term, yes, staples should bounce back because the commentary in 1Q was slightly better than what we anticipated. There is some pickup in urban growth, which is happening. Rural has been strong for last 3-4 quarters. So staples should also join the party. But after the initial 5-10% rebound, I think, again, people will start looking at volume growth, how all the announcements are actually translating into numbers. Whereas for discretionary consumption, I think the road is very clear for next 3 to 5 years, which is why in our model portfolio, we are disproportionately overweight on consumer discretionary.
Okay, all right. Discretionary over staples. That's Gautam's call. Gautam, give us a few names. Trend is something that you identified early. The stock had a one-way move before pulling back. If discretionary is going to do well, is that one of your top picks? If you could give us, what's the outlook with regard to stocks? How do you play this discretionary basket? And also, there was this EMS place that suddenly got very jittery after PG Electroplus went ahead, and cut their guidance. But clearly, RAC sales will move up. Then these guys as well will benefit. What's your top idea over there?
Yeah, so that's why you're seeing EMS companies, rallying today, including PG Electroplus. While we don't have coverage on PG, but we have coverage on 8 other EMS names. Our preferred ideas there are Dixon, Keynes, and Amber. They are also doing well in today's trade if AC sales go up. And even otherwise, outside of this GST announcement also, they were growing at a very fast clip. I mean, EMS as a pack this quarter posted 58% earnings growth. As regards our choice for discretionary consumer companies, in our model portfolio, we have 5 of them. Titan, which has been our long time favorite, obviously remains a favorite idea. They posted very strong set of numbers too. We like Page. We've been a big fan of Indian Hotel for last 4 years. We've been holding Indian Hotels. Then we have introduced Jubilant Foodworks in our model portfolio recently. Page Industries is there. And aside of that, we also have a positive view on Indigo Airlines and Varun Beverages. So there is a whole host of ideas in consumer discretionary, Nigel. You're spoiled for choice there. Unlike in staples, where you have to still shuffle between 7-8 companies. In discretionary, you have 50 potential investable ideas. And my sense is that as we move forward in next 3 to 5 years, as our per capita moves from $2,800 towards $4,000, you will see another 100 ideas coming up and listing.
Okay, interesting. 50 plus choices, spoiled for choice in the discretionary side of consumption. Gautam, thank you so much for joining us this morning, giving us insights in terms of markets and how this story of consumption is going to start playing out in this year.